Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to show you one option strategy that can be used if you're trading with a small account. That option strategy is going to be none other than a PMCC or poor man's covered call. Now, if you're new to options or you're trading with a small options portfolio, then this is that one option strategy that could help you grow your accounts portfolio exponentially over time while doing this very safely. So, if this piques your fancy, then I suggest you continue watching. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, we're going to be going over the PMCC or Poor Man's Covered Call. I'm going to show you how I use this option strategy to single-handedly grow my portfolio exponentially. Now, on this channel, we focus on option strategies that receive income right away that helps you to grow a small account portfolio. I too started off with a small account portfolio, and when I searched YouTube for ways to grow my small account portfolio, there wasn't much material. Hence, I make these videos. Now, for today's video, we're going to be using Micron Technology, ticker MU. Now we're going to go ahead and we're going to get down and dirty with options. Now, when we say we're going to get down and dirty with options, it simply means that we're going to be giving you an actual walkthrough of how to perform these strategies in order for you to be able to follow along with us. Now, we try to keep the option terms at a minimal in order to not to confuse you. Options is not hard, it's not that difficult to learn. If you guys are interested in learning option strategies that continuously help you to generate consistent income, then check out the links in the description below. That being said, it's time to get down and dirty with options. So for that, we're going to go to the bottom and we're going to go to Trade MU Options in order to open up the option chain. Now we have the option chain open really quickly. For those of you that are new to option trading, this area down here is known as the option chain. The option chain gives us enough information in order for us to make an informed decision before getting into any option contract. Now, to get this started, let's first go ahead to buy and we're going to go ahead to call. And now we're going to go ahead and choose our expiration date. For this option strategy to be the most effective, it is highly advisable that you choose your strike date about a year out, which is more than 365 days. So we're going to be going with the March 20th, 2026, which gives us 375 days to expiration. Now, before we go any further, I always require two things from my subscribers. Number one, always make sure you do your own due diligence before investing. And number two, always make sure you have an exit strategy before getting into any option contract. Now let's go ahead and continue with the video. So now that we have buy and we have call and we have chosen our expiration date more than a year out, we're going to go ahead and choose our strike price. The strike price we're going to be using is going to be the $80 strike price. And with the $80 strike price, we have what's known as a delta of 0.69. I'm going to get back to the delta in just a second. So with the $80 strike price, you could see strike price to the top here and a 69% delta. You could see delta to the top column here. We're going to have to pay some amount of money. Anytime you're going to buy anything, you're going to have to pay. The amount we're going to be paying is going to be $23.30. In the option world, each option contract contains 100 shares. By simply multiplying 100 shares by 23.3 per contract, you will now get $2,330. So in order for us to get this option contract, we're going to have to pay $2,300. Let's go ahead and click into it. So as you can see to the top here, it says long call or what's known as a LEAPS option. Now, LEAPS stands for long-term equity anticipation securities. It is a mouthful. That is why we all say LEAPS. Now, LEAPS is just the first part of the PMCC option strategy. Now, let's get back into the strike price. Now, the break even. The break even here, you need to pay close attention to this whenever you were to go to pick up a LEAPS option. The break even tells you that you need to sell over call, which is the second part of the PMCC strategy. And do not worry, don't get confused. We're going to go over that as well. What is telling you that once you sell your covered call, you would need to sell your covered call at any price above 103.1. So your break even is very important, and also your delta is very important. What your delta tells you when you pick up a leaps option is that any movement in the share price of $1 in any direction, up or down, this entire option contract is going to change by $69, up or down. So let me break it down very simply for you. If the share price moves from $86 to $87, then this entire option contract is going to go up by $69. So it's going to be $23.30 plus 0.69. That's how that works, and vice versa. Now let's go ahead and we're going to open up the strike price in order for us to check out the Greeks. Whenever you were to pick up any options, leaps options for that matter, always make sure you just pay a bit more attention to the Greeks. Now, what I want to call to your attention is the implied volatility here. The implied volatility here is 53.38%, which is very decent for option trading. Just as a rule of thumb, any implied volatility of 1 to 50% is very low and you would not be paying some decent premium. Implied volatility of 50% to 100% gives you some very decent premium without taking loss of risk. Any implied volatility of 100% and above, that is definitely going to risky territory. So use implied volatility before choosing your options. We already went over the delta of 0.69. Whenever choosing a leaps option to buy, the rule of thumb is to look for a delta of 0.7 or higher. The reason for that is that the delta also represents the amount of the stock you own. So for instance, if you were to buy a leaps option at a 70.7% delta, that tells you that you own like 70 shares of the stock, and vice versa. If you get a delta of 0.99, that tells you own 99 shares of the stock. So the delta just shows you the percentage of 100 stocks that you own. It also is used to calculate your gains, and we're going to get to that on the second part of the PMCC. Now, the open interest here is 163, which is very low. The open interest just tells you how much of this particular option contract is open. The volume tells you how much of this option contract has been open and has been closed. So it's only 11. Now, I don't mean to get technical, but I just wanted you guys to learn this. It really, really does help. So why would anyone want to pick up a leaps option? Well, I did mention that the leaps option is perfect if you're trading with a small account portfolio. The reason for that is that it allows you to control 100 shares of a stock. If you're able to control 100 shares of the stock, then you can use that option strategy in order to make consistent income. So, for instance, if you were to buy 100 shares of this stock right now outright, it would cost you $86 per share, which is going to work out to be $8,600. Now, when trading with a small account, this might be a lot to digest in order to put into just one single option contract. What the leaps option allow you to do is that it allows you to control 100 shares for a lot less. As you can see, you're now able to control 100 shares of the stock for just $2,300, which makes a huge difference between the $2,300 and the $8,600. So that is one reason why someone would want to pick up a leaps option. The other reason you're going to pick up a leaps option is that a leaps option represents a buy and hold strategy. So if you wanted to pick up a leaps option because you're of the mindset that the market is going to continue going up, you could literally buy a leaps option, leave it in your portfolio, and do nothing. I guarantee you, over time, if you have chosen the right expiration date, this is going to go up and you will make money. However, as an option trader, especially for me, I'm what's known as an income option seller. I like to make money whenever I do an option strategy. So if I'm buying any option, it's with the mindset that I could use it to make some kind of premium. That being said, let's get into the second part of the PMCC. For that, we're going to go ahead and change up the strategy just a tad. So remember, we have our $80 strike price. We have our $103 break-even price. We have a 0.69 delta, and we paid $23.30. Now we're going to go ahead, we're going to go to sell, and we're going to go to call. And now we're going to change the strike date. The strike date we're going to be using is going to be March 21st, which gives us 11 days. Now, the reason why I use this stock, I do have it in my portfolio, is that this stock does not fluctuate as much as some other stocks. As I showed you, the implied volatility on this is in the 50 percentile. So I'm going to be going with March 21st, which gives me 11 days until this option is going to expire. So now I'm going to go ahead, I'm going to choose my strike price for this option. Now, my strike price I'm going to choose, I need to choose a strike price of anything above $103. Remember, we just saw the $103 break even. So if you were to choose any price above the $103 right here, then that would be a good price. And no matter how the trade goes, you're still going to win. However, me personally, I'm a very conservative investor. So what I'm going to do is that I'm going to go ahead, I'm going to choose a strike price a bit higher. And I'm going to be going with the $112 strike price right here. And that gives me an even higher percent chance of profitability, almost 94%. Now for that, I'm going to be paid 0.59 or $60. Now, the reason why I went with 112, there's no need for it to go with 112 strike price. Feel free to go with anything above 103. The reason for me doing this is because I want to keep the leaps option in my portfolio for as long as I possibly can while keep generating consistent income. Remember, the leaps option is similar to a buy and hold. The added bonus is you making additional income while you're waiting for the stock to appreciate, or what I call on this channel, get investment gains. So I'm going to be settling for my $59 and I'll be happy for that. This secondary strategy is known as the covered call option strategy. When you buy a leaps option in your portfolio that allows you to control 100 shares, then you go ahead and use the leaps option in order to sell some consistent covered calls. Those two strategies together is what's known as the poor man's covered call. And no, you do not need to be poor in order for you to do this strategy. The whole reason why it's called the poor man's covered call is because you're able to control the stock at a lot cheaper price than if you were to buy it outright. Now, how does this trade work out? So there's a couple ways in which this trade could go. Come expiration date of March 21st, if this share price right here, $86, so happen to go past the $112 strike price that we chose, then we're going to be assigned. Now, assignment is not such a bad thing. Assignment means that we're going to now lose our leaps option. The PMCC is what I consider to be a win-win option strategy. And here's how. Once we get assigned, we're going to be losing our leaps option. But we get to win because now we get to keep the premium that we receive. This premium here is ours to keep no matter what. And now we're going to get some additional income, and that additional income is going to come in the form of what's known as capital appreciation or investment gains, meaning that now you're going to be selling your leaps at 112. So now you're going to minus the share price that you bought the leaps at, which is $86. You're going to subtract that from 112, and that should give you $26. We are dealing with option contracts. So now you're going to multiply that, which is going to be $26 by 100 shares. That's now going to give you $2,600 of investment gains. That is not your total income. You're now going to have to remember that tidbit I showed you about the delta, which was 0.69. You're now going to multiply the $2,600 by 69%. And now your actual investment gains is going to be $1,794 plus your $59, which is going to give you a grand total of $1,853. Now, $853 in a 2-week span of time is very, very good investment gains. Now, that is one way the trade could go. Now, let's say come expiration date of March 21st, this share price here does not hit your 112. Well, you do not have to worry because now, once again, you get to keep your $59 premium. Remember, that little premium you get on a consistent basis is what's going to be used in order to help you grow your small account portfolio. And then now you're going to have your leaps that you use as collateral. That's going to be released back to you. And now you're able to do this strategy over and over again until you actually get assigned. Now, this is where this is another win for me. If the share price does not hit this price here, I have no issues with making a consistent $60 every single other week to grow my option portfolio. If you were to divide $59 by the amount you paid for the leaps option, which is going to be 59 divided by 2330, you're actually going to be receiving a 2.5% return. A 2.5% return every other week is extremely decent. Now, the other reason why I chose the very high strike price of 112 and the very high chance of profitability, I only settled for $59, is that this stock is going to be having earnings close to this expiration date, is going to be having earnings on the 20th of March. So also always make sure you keep these kind of things into consideration. The other thing you need to keep into consideration is that this stock also pays a small dividend. When dividends are involved, that changes the game just a bit because the dividend offered is really small for this stock. So there you go. That is the PMCC for small accounts. Now, the PMCC, or the poor man's covered call, is a combination of two option strategies. You must firstly be able to buy a LEAPS option, which is a long-term equity anticipation security that allows you to control 100 shares of any stock. Once you're able to pick up a LEAPS option in your portfolio, you can then go ahead and sell covered calls against your LEAPS, and your LEAPS are going to be used as collateral. No matter how this trade goes, it's always a win-win-win. In order for you to never lose with this option strategy, always make sure you do this strategy on good qualified stocks. To make it easy, just choose stocks in the S&P 500. That just reduces your risk significantly. So, if you have any questions about the LEAPS option strategy, please leave me a comment below. Go ahead, like the video, subscribe to the channel, and if there's anyone out there that's struggling to grow a small account portfolio, then feel free to share this video with them. And until the next video, keep using the PMCC.